Hi, welcome to The Week That Was, where we break down all the biggest events from the week and tell you how it impacts you and your money. Let's start with the markets. Just last week I was talking about how the Indian markets have been surging week over week, giving you this illusion that wealth creation is simple, easy and fast. This week, reality has struck. Most global indices were drenched in red and Indian markets have corrected over 4.5% in just 4 days. This marks one of the steepest corrections this calendar year. There are two reasons to it. One, the Middle East crisis that doesn't require much of an explanation. Two, the resurgence of China. The Chinese markets and the economy have been underperforming over the last few months. The Chinese government have announced a staggering $118 billion market rescue package, as well as have announced policies to spur up the growth. This has brought in renewed optimism as well as cheer in the Chinese market. Foreign investors who have been pouring money into India seem to have changed sides. They find China more favorable now. Just last week I spoke about how foreign investors had brought in a record 56,000 crores into India. But in just 4 days, they have pulled out over 30,000 crores. That is 50% more than what they had brought in over 30 days. Market sentiments flip overnight. But here's the silver lining. If your asset allocation and diversification strategies are aligned with your life goals, that is, investing in different asset classes such as equity, debt, and gold, these small minor dips should not bother you or your portfolio. So stay true to your investments or financial plan and continue your SIPs. Moving on to the bigger stories. First, monsoons. Monsoons are retreating, so it's a good time to take stock of how well they did this season. In Bangalore, we did get copious amount of rain, and that's a relief. Monsoons this year was 20% better than last year and 8% better than long-term average. All regions except 5 states received average or above average rainfall. We are expecting a good kharif crop yield. That's your rice, pulses and sugarcane. So much so, the government has revoked a ban on non-basmati rice exports. The other metric that we track is the reservoir levels. The reservoir levels currently stands at 81%, up from 67% last year. This would benefit the Rabi crop season. That's your wheat and mustard. So what does this mean? This means that more income to the rural communities, more savings and more consumption. This will give a boost to the rural economy that has stagnated over the last few quarters. This will have a positive impact on the GDP and the growth number will be more inclusive. 3. OpenAI raises funds and doubles its valuation. OpenAI has raised an impressive $6.6 billion at a valuation of a staggering $157 billion, making it the most valuable private company. This time, Nvidia has joined the party along with Microsoft in this fundraise. To put these numbers into perspective, the Indian startup raised a cumulative of $3.1 billion in the last quarters. That's less than 50% of what OpenAI has raised. As investors, it's a good reminder that you cannot ignore the US markets, or sometimes known as the mother market. OpenAI revenue stood at $3 billion. However, their losses are over $5 billion. OpenAI expects their revenue to jump up to $11.7 billion next year. That's a 4-fold increase. This seems possible considering that OpenAI has converted from being a non-profit organization to for-profit organization. I just hope their drive for profit does not compromise their core mission to ensure artificial intelligence benefits everyone. Our fourth story takes us back to China. 30 years and zero returns. China is the second largest economy and has been synonymous with manufacturing, export, and growth over the last 3 decades. But one quick look at this MSCI China index, you'll realize that China is back to where it was 30 years back. Its net gains, zero. You heard it right, zero. You'll also see massive upswings and downswings, which indicate the volatility with equity investing. If this can happen to China, which frankly speaking is way ahead of India on several economic fronts, how confident are we that this wouldn't happen to India? Don't worry, charts do not tell you the entire story. But here are some key lessons as investors. As investors, we should not get carried away by the euphoria that we see during the upswings, because downswings are very much part of equity markets. Simple strategies such as taking some profits off from your equity investings when they give you better than average returns and moving it into safer, low yielding debt funds will protect you from those downswings. When the markets do correct, selling off your debt funds and moving back to equity will ensure that your portfolio is ready for the next big upswing. The other key thing is monthly SIPs. Monthly SIPs ensure that you get to buy into the market when the markets are at their low as well as when they are at their highs, giving you average prices. Monthly SIPs along with asset allocation and diversification will ensure you get potentially greater returns from the market. It's important that you have a financial plan or an investment plan and stick to it. On that note, we come to the end of the week that was. Thank you.